I think there's something going on there socially that the government is very worried about. Many of the same things that the rest of the world is worried about, whether it's the divide between the rich and the poor. I saw today Evergrande. There are protests around the Evergrande offices because the wealth management products that weren't highly regulated are not paying interest or not paying back and so forth. So I think there's social unrest taking place there. And that's why common prosperity has become the rallying cry, and hostage to capital has also become a rallying cry. So I don't think it's a very friendly place for capital now.
That was Cathie Wood speaking at SALT conference about a year ago. Since then, however, things have not gotten better in China. In fact, the Chinese economy has come under further stress. We have already covered the Evergrande crisis on this channel before, and how the real estate giant's weaknesses continue to threaten the stability, not just of China's huge real estate sector, but of the country's entire economy. In this video, we want to provide an update on the state of the Chinese economy, especially after the strange political dynamics we've seen displayed at the 20th National Congress, which ended on October 22nd. One such event was the removal of China's former leader, Hu Jintao, from the Congress meeting. CNN wrote that, like many unexplained episodes in the black box of elite Chinese politics, the true reason behind Hu's unexpected departure may never be known. But experts say the symbolism, unintended or otherwise, is hard to miss. Having eradicated any vestige of influence from party elders or rival factions, Xi has ushered in a new era of one-man rule surrounded by only staunch loyalists. President Xi Jinping has consolidated his leadership, at least that's how it appeared to most of the world. But what kind of economy is he going to lead? The first to respond to President Xi's consolidation of power were financial markets. Investors were alarmed about what the new Chinese leadership may mean for their money. The Financial Times highlighted this sentiment when it wrote that analysts and fund managers had expected Xi to balance his 7-man leadership team by including at least a couple of moderators. Instead, it became clear that he had taken sole charge of the world's second-largest economy. Therefore, the first thing to stress about the Chinese economy under the new leadership is that global investors can expect further uncertainty. In a world already disrupted by conflict in Eastern Europe, massive inflation and central bank tightening, this added element of volatility will not bode well for financial markets. Secondly, the macroeconomic picture does not look encouraging either. President Xi has ambitious plans for China. He wants the country to overtake the US as soon as possible. But the underlying forces that ultimately decide whether an economy grows are not on the Chinese leader's side. Growth in the long term depends on more workers using more capital, and using it more efficiently, productivity. However, China faces a collapsing population. Its birth rates are plummeting while the number of elderly people is growing. These forces put downwards pressure on labor productivity, acting as a drag on future economic growth. Moreover, before the global financial crisis, the Chinese debt-to-GDP ratio was about 150%. In 2015, this figure grew to 220%, and in recent times it's skyrocketed close to 300%. This means that each renminbi generated as a result of productive economic activity must service 3 renminbi of debt. This is a highly unstable situation for the Chinese economy. It is against this troubling background that the Evergrande crisis came about, shaking the Chinese real estate sector to its core. It is important to stress that in China, the real estate market is much bigger as a component of wealth for the country's population than it is in America or Japan. There, stocks and bonds form a more proportional representation of wealth of their populations. As such, the ongoing crisis at Evergrande threatens not only investors' money, but the livelihoods of the Chinese people. A few years ago, economists across the Western world were predicting that China will overtake the US economy in the near future. With these macroeconomic headwinds and political uncertainty now presiding over the country, this prediction now seems nothing but a dream. Even hedge fund manager Ray Dalio, who has been a bull on China for a long time, is starting to realize that the economic reality of the Chinese state is weakening.
China has been the leading competitor. I've been having, not since 1984, I've been going to China. Watch it since I started going there. Per capita income has increased by 26 times. And so if you use measures of comparability in military, technology, share of world GDP, all of that, you see that. That is the only real power. There are military powers, but history has shown if you're a military power and you're not an economic power, while you may be a threat, you're not going to win the war.
The war Dalio is talking about is the war for global competition. Competition of political power, of natural resources, and of technological supremacy. China can have a powerful military, but without economic stability, its role in the world is undermined. However, The Economist wrote in September of this year that a weak China may be more warlike than a strong one. This makes sense. When a country is pushed into a corner, economically speaking, and its population begins to suffer, extreme measures seem appealing to the broader population. Think about what happened to Germany after World War I. The country's economy was shattered, its society was poorer by the day, and everything seemed lost. Then, in those dark times, radical politicians rose to power and World War II began. The British magazine The Spectator wrote recently that there is good reason for Xi to believe that, by upping the ante to full-blown war, the Americans will back down. We are not saying that war is likely, only that a weaker economy can lead to desperate measures. China still has achieved a great deal over the past 30 years. It has lifted many people out of poverty and has recovered a lot of ground in terms of technology and political power. But these came at huge costs, most accurately reflected in the rampant amounts of debt that plague every sector of the economy. The Chinese system, like those in the West, is linked by liquidity, which is influenced most powerfully by debt. This debt is created with the support of the central bank, but it is produced by commercial banks. When a loan is made, a deposit is created. This deposit represents new purchasing power, i.e. liquidity. With this additional liquidity, Chinese businesses have produced and consumers have bought goods and services, even with money that they did not have. In 2022, there were 1,133 billionaires in China, compared to 716 in the United States. But how much of this wealth is real, and how much is tied to debt-based investments and hyperinflated property values? Probably a lot. To create wealth, it takes a long time. Generations upon generations. It cannot be built overnight. However, debt creates this illusion that somehow a country can skip tens, if not hundreds of years of development. History shows again and again that this cannot happen. Eventually, what is built on sand will fall, and China's economy is mighty wobbly right about now. On the 1st of November 2022, it was reported that Al Jazeera that China's property market continued its slump in October, with private data showing home prices and sales falling, suggesting lackluster sentiment and a bleak outlook. Everything falls in a domino-like fashion. First is the real estate sector, then the banks, then the investment industry, then the consumers get hurt, and soon the whole economy is in need of dire reforms. The Lehman Brothers collapse that triggered a global banking crisis in 2007 to 2008 happened in a similar fashion. Years of bad money management and debt piling collapsed in weeks, then days, and then hours, pulling down the entire world's economy. The signs are on the wall for China too, but maybe we are wrong. Maybe Beijing will manage to stir the Red Dragon into another direction before it is too late. What do you think will happen with the Chinese economy? Are we seeing the right picture about its fate, or are we too pessimistic? Let us know in the comments below. Thank you for watching, and please subscribe and like this video for more content.